Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Mastering Credit Analysis for Smart Investing in 2024. Are you ready to make smarter investment decisions? Understanding credit analysis is key to identifying solid investment opportunities and avoiding pitfalls. Credit analysis involves evaluating the creditworthiness of a borrower, whether it's a corporation or a government entity. This process helps investors gauge the risk of default and determine whether an investment aligns with their risk tolerance. In this video, we'll break down the essentials of credit analysis, including the main factors analysts consider and how these insights can guide your investments. You'll learn how to interpret credit ratings and financial ratios, and how to use this information to make informed decisions. Ready to dive in? Let's get started. What is credit analysis? Credit analysis is the process of evaluating the creditworthiness of an entity, like a company or person. It helps us understand if they can repay their debts. Think of it as a financial report card. This analysis is essential for lenders to decide if it's safe to lend money. Key components of credit analysis. Understanding credit analysis means knowing what credit analysts look at. Here are the main elements. Financial statements. These include balance sheets, income statements, and cash flow statements. Financial statements show the entity's revenue, expenses, profits, and overall financial health. Cash flow analysis. This helps to see if the entity has enough cash coming in to pay its bills. Positive cash flow means they can handle debts more easily. Economic conditions. The broader economic environment also plays a role. Factors like interest rates, inflation, and economic growth can impact the entity's ability to repay loans. Types of credit analysis. Credit analysis can be broken down into 2 main types. Fundamental credit analysis. This focuses on the financial health of the entity. It looks at tangible data like financial statements and economic indicators. Technical credit analysis. This type looks at market-based data. It examines things like stock prices and trading volumes to predict creditworthiness. In sum, credit analysis is like doing a financial checkup. By examining various elements and using different approaches, analysts can assess whether lending money is a good idea. The importance of credit ratings. Credit ratings play a crucial role in the world of investing. They give investors a clear idea of the financial health of a company, country, or other entity. Knowing a credit rating can make or break investment decisions and directly impact borrowing costs. Let's explore this in more detail. Credit rating agencies and their methodologies. Credit rating agencies are specialized companies that assess the creditworthiness of different entities. Some of the major players in this field include S&P Global Ratings. Standard & Poor's, S&P, is one of the biggest names in credit rating. They use a scale ranging from AAA, the highest rating, to D, which indicates a company is in default. Here's a quick look at their scale. AAA. Extremely strong capacity to meet financial commitments. A. Very strong capacity. A. Strong capacity but somewhat susceptible to changes in circumstances. BBB. Adequate capacity. Higher risk during economic downturns. BB and below. Considered speculative, higher risk. Moody's Investors Service. Moody's also provides credit ratings and uses a similar scale but with slight variations. Their ratings span from AAA to C. AAA, highest quality, minimal credit risk. A, high quality, very low credit risk. A, upper medium grade, low credit risk. B, medium grade, moderate credit risk. B and below, speculative to highly speculative. Fitch Ratings. Fitch Ratings completes the trio of major rating agencies. Their system also uses a familiar scale, from AAA to D. AAA, lowest default risk. A, very low default risk. A, low default risk. BBB, moderate default risk. BB and below, increasingly high levels of default risk. These agencies evaluate financial statements, market conditions, and other factors to determine their ratings. Their methodologies offer a standardized way to judge creditworthiness, which is vital for investors making informed decisions. Impact of credit ratings on markets. Changes in credit ratings can send ripples through the market. Investors look at these ratings to gauge risk and decide where to put their money. Here's how credit ratings can influence the market. Investor behavior. Confidence. A high credit rating can boost investor confidence. It suggests that the entity is stable and likely to meet its financial commitments. A low rating, on the other hand, can scare off investors and cause them to look for safer options. Portfolio adjustments. Investors often adjust their portfolios based on credit ratings. A downgrade could prompt selling off the entity's bonds, while an upgrade might lead to more buying. Market dynamics. Borrowing costs. Higher credit ratings generally result in lower borrowing costs. Entities with good ratings can issue bonds at lower interest rates, saving them money in the long run. Conversely, poor ratings mean higher interest rates. Market prices. Credit ratings can affect the prices of bonds and stocks. A rating upgrade can drive up prices, while a downgrade can lead to a drop. In conclusion, credit ratings are like a financial report card. They help investors decide where to invest and influence the broader market. Understanding how these ratings work can be a game changer for those looking to make informed investment decisions. Conducting a credit analysis for investment. When investing, one must understand the creditworthiness of the potential investment. Credit analysis helps evaluate whether an entity will repay its debt on time. Here's how to conduct a thorough credit analysis. Gathering financial data. First, you need to collect reliable financial data. This data gives you a picture of the company's financial health. Sources for this data include financial statements, balance sheets, income statements, and cash flow statements provide a clear picture of the company's financial status. Annual reports. Companies publish annual reports that contain a wealth of financial information and management analysis. Credit reports. These reports offer insights into the company's credit history. SEC filings. Public companies must file reports with the SEC, which are valuable resources for financial data. Market data. Information such as stock price trends and market conditions. Key metrics to analyze include revenue, profit margins, and cash flow. These metrics show if a company is making money and managing its cash effectively. Performing ratio analysis. Once you have the data, it's time to perform ratio analysis. Ratios are essential tools that help in evaluating the financial stability and performance of a company. Here are key ratios to consider. Debt-to-equity ratio. This ratio measures a company's financial leverage. It's calculated by dividing total liabilities by shareholders' equity. A high ratio may indicate that a company is heavily financed by debt, which can be risky. Interest coverage ratio. This ratio shows how easily a company can pay interest on its outstanding debt. It's calculated by dividing earnings before interest and taxes, EBIT, by interest expenses. A higher ratio indicates better financial health. Current ratio. This ratio measures a company's ability to pay short-term liabilities with short-term assets. It's calculated by dividing current assets by current liabilities. A ratio above 1 suggests the company can cover its short-term debts. These ratios help in understanding the financial risk and health of a company, guiding you in making informed investment decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.